Good morning. Today we're going to be discussing the signs that we've seen of cooling in the US labour market and why equities and bonds have rallied. Yesterday we had data from the US that showed that the labour market is showing signs of cooling. So we looked at the series called the JOLT series, which looks at job vacancy. So this is companies that are advertising for jobs. That actually declined to its lowest level since early 2021, going from 9.2 million job vacancies to 8.8 million. This is well below the 9.5 million, which was expected by economists and investors. Why is the job market being so tight? Unemployment is currently at 3.5%, so at historic low levels. Coming out of COVID, consumers want to go out and spend, and they wanted to do that aggressively. In order to meet that higher demand, companies had to increase production and also increase their workforce. There was a lack of labour supply, so naturally, in order to entice workers, they had to pay higher wages. The challenge for that, whilst it's a positive for consumers, it's a positive for business in terms of demand, it does risk that inflation, which is already at elevated levels, would be higher for longer. Central bankers, an issue when inflation is above their 2% target, they needed to try and slow the economy down and and reduce the strength of the US labour market. And so therefore they increased interest rates aggressively and have been doing so for the last 18 months. The market has been looking for signs that wage growth and the labour market is cooling, and therefore that means that the further interest rate hikes would not be necessary. When we look at the details yesterday, yes, job vacancies showed declines, but also the number of people that are quitting their jobs also declined by 250,000. So still 3.5 million people quitting their jobs in seeking better job opportunities, perhaps higher wages, but the confidence is slowing. And that's a real positive when we look at this kind of corresponds with other data yesterday from the Conference Board, which surveys consumers on their overall confidence levels. The share of respondents indicating that jobs were plentiful also declined. So again, another signal that the labour market is cooling. When we look at how equity markets responded, US equities were very strong, up 1.5%. All sectors delivered positive returns, but it was really technology, consumer discretionary, which led the way. UK equities were also having a very strong day, partly catching up from the strength in global equities on Monday, but really led by home builders, which were boosted by lower bond yields. US government bonds rallied on the expectation that an interest rate hike in September was unlikely. That's everything from us today. Thank you for watching, and we'll see you tomorrow.